Warren Buffett was 19 years old when he found a book that changed his entire life. Not a stock tip, not a secret formula, a way of thinking. That book was The Intelligent Investor, and Buffett still calls it the best investing book ever written. Today we break down 5 lessons from it that are simple enough for anyone to grasp, yet powerful enough to separate people who build real wealth from people who just chase hot tips forever. Picture a business partner who shows up at your door every day with a new price for your share of the company you own together. Some days he's euphoric, begging to buy you out far above what it is worth. Other days he is convinced the world is ending, offering you pennies. Graham called him Mr. Market. The lesson is simple. You are never required to trade on his terms. During the 2020 crash, dominant companies went on sale not because their future had dimmed, but because fear took over the room. The investors who ignored Mr. Market's mood and asked what the business was actually worth came out ahead. Investing and speculating are not the same thing. A true investment requires real analysis, real safety, and a reasonable return, not a jackpot. Buying a stock because it is trending online with no idea what the company even sells is not investing. It is gambling with better marketing. The dot-com bubble proved this. Fortunes poured into companies with nothing but a website and a dream, and when reality caught up, trillions vanished overnight. Even a great business can be a bad investment at the wrong price. That is why Graham demanded a margin of safety. Never pay full price because your analysis could be wrong, the economy could shift, anything could happen. During the 2008 crisis, rock-solid companies traded far below their real worth simply because panic had gripped the market. The investors who had built in a margin of safety were ready to buy while everyone else was frozen. Graham also insisted you choose a lane. Either you are a defensive investor, sticking to broad index funds and consistent contributions, or you are enterprising, willing to put in real hours studying businesses. The danger is the middle ground, where people feel like experts while actually just reacting to headlines. And here is the biggest lesson of all. Your worst enemy in investing is not the market. It is yourself. Fear makes you sell at the bottom. Greed makes you buy at the top. The fix is not willpower, it is structure, rules you set in advance so you are not making decisions in the heat of panic. Put it all together and you get a simple formula. Treat stocks like real businesses, demand a discount, ignore the noise, pick your lane, and build a system that protects you from your own emotions.